Okay, let's take a look at exercise 12-3B. I found if you can do this one, you can do 12-2 pretty easily, so this is a better one to look at. So in this case, Pella Company presents its statement of cash flows using the indirect method, which is what we're studying in our class. The following accounts and corresponding balances were drawn from Pella's year 2 and year 1 year-end balance sheets. So I've got current assets of accounts receivable, prepaid rent, and interest receivable. And then I've got current liabilities of accounts payable, salaries payable, and unearned revenue for both years. The income statement reported a $700 loss on the sale of equipment and a $900 gain on the sale of land and $2,500 of depreciation expense. Net income for the period was $36,500. So remember this little matrix that I had in the lecture notes there, where an increase in a current asset is going to have a negative impact on cash flow. A decrease will have a positive impact on cash flow. And then the reverse is the case with current liabilities. So it's always a good idea to write that down on your paper or where you can see it easily so that you can refer back to that when you're working through this problem. So the first thing I like to do is to determine what the impact of these changes in current assets and current liabilities are. So I found the best way to do that is to lay it out as you see here, where I've got my current assets. So in this case, accounts receivable went from, notice I'm excluding cash because the difference in cash is something that the whole statement is going to solve for. So we don't look at that difference here, just non-cash current assets. So in the case of accounts receivable, it went from 21,000 to 24,000. That's a $3,000 increase. You could ignore these arrows for right now. Prepaid rent went down 250, interest receivable went down 300, so I've got negative amounts there. Accounts payable went up 1,700, salaries payable went down $200, and unearned revenue went up $200. So now I come back to here and I look at this little chart, this little diagram I made here. And so an increase in a current asset is going to have a negative impact, a decrease, a positive impact. So then I put these arrows here. So I have a negative or a downward arrow here, negative impact for the increase and positive impacts for the decreases. And then for current liabilities, an increase has a positive impact and a decrease has a negative impact. And so I put those arrows there. So when I go to do the statement of cash flows, I'm not going to look at the sign of the number here, whether it's positive or negative. I'm only going to look at the direction of the arrows. So to go ahead and start this, the first section is going to be starting with net income and then making adjustments to net income. I'll add the depreciation expense because we didn't write a check for that. There's no cash flow associated with that. I'll add the loss on the sale and subtract the gain on the sale. That'll get me from net income to operating income. So the next thing I'll do is I'll record all of these changes in current assets and current liabilities. So I put them in the same order I have them above. I label increase in accounts receivable or decrease in prepaid rent. And then I put the numbers here and the sign of the number. The reason this is negative is that I have a downward arrow here. So again, the direction of the arrows indicates if I'm going to have a negative number here or a positive number here. And then I simply add all of these up and I get cash flow from operations of $38,050. So hopefully you found that helpful. If you have questions, please don't hesitate to send me an email. Thank you.